Have you ever stared at a stock chart after a massive market crash and thought, there had to be a warning sign? It often feels like the market moves in complete chaos, trapping everyday investors at the absolute worst times while the pros seem to magically exit right before the cliff. But what if the market isn't actually random at all? What if every single stock, index, or cryptocurrency goes through a predictable, repetitive life cycle that you can spot with your own eyes? Imagine being able to look at any chart and instantly know whether you should be aggressively buying, holding on tight, or running for the hills. Today, we are going to put one of the most famous market cycle frameworks in financial history to the ultimate test. We are going to strip away the hype, ignore the talking heads on television, and look purely at the cold, hard historical data to see if this classic method can truly protect your portfolio and grow your wealth. The method we are talking about is called Stan Weinstein stage analysis, created by the legendary market analyst Classical Technical Analysis in his groundbreaking 1988 book. Weinstein's core philosophy is incredibly elegant. He argues that instead of guessing where a stock is going, you should simply identify which of the four distinct stages it is currently in. Stage 1 is the accumulation phase, where the price moves sideways as big institutions quietly buy up shares. Stage 2 is the advancing phase, which is a powerful, sustained uptrend where the real money is made. Stage 3 is the distribution phase, where the smart money starts selling to latecomers, causing the price to stall and churn. And finally, Stage 4 is the declining phase, a brutal, wealth-destroying downtrend. Weinstein's rule was simple: only buy during Stage 2, and absolutely never hold a stock during Stage 4. It sounds beautifully logical, but does it actually work when applied to a modern, highly liquid index like the S&P 500? To understand how we backtested this, we first need to look at how we mathematically define these stages. Weinstein relied heavily on a simple but powerful tool, the 30-week simple moving average. In our test, this acts as the line in the sand separating bull territory from bear territory. For Stage 1, we look for a period where the price is moving sideways in a relatively narrow range, and the moving average itself starts to flatten out. The magic happens at the transition into Stage 2. This occurs when the price violently breaks out above the upper boundary of that sideways range on high volume, with the moving average now clearly sloping upwards. This breakout is our green light to buy. In our backtest, we simulate this exact moment. The instant the price confirms this breakout, we enter a long position, expecting to ride a massive, multi-month wave of upward momentum. But getting in is only half the battle. Knowing when to exit is where fortunes are saved. As the uptrend matures, it eventually enters Stage 3. The price starts making wild swings up and down, but it stops making new highs. The moving average flattens out again, and the price begins to repeatedly cross back and forth through it. This tells us the buyers have lost control. The final disaster is Stage 4, which begins when the price breaks down below the support level of that Stage 3 trading range, and the moving average starts sloping downward. In our systematic backtest, we don't wait for the absolute bottom of Stage 4 to sell. We use a strict trailing exit strategy. If the price falls below our defined support level or crosses below a declining moving average, we immediately sell our position and move to cash. This ensures we are completely out of the market before the worst of the damage occurs. To appreciate why classical technical analysis's approach became so famous, we have to look back at the historic market crash of October 1987, famously known as Black Monday. While the rest of Wall Street was panicking as the Dow Jones fell over 22% in a single day, Weinstein had already warned his clients to get out of the market. His stage analysis had clearly shown that the market had entered Stage 3 distribution in the summer of 1987, followed by a clear breakdown into Stage 4. By refusing to fight the trend and simply following his rules, his followers were sitting safely in cash when the crash hit. This historic event cemented his reputation as a master of risk management. But the financial markets of the 1980s were very different from today's high-frequency, algorithm-driven markets. That is why we need to test this strategy on modern data to see if it still holds up. For our rigorous backtest, we chose SPY, the exchange-traded fund that tracks the S&P 500 index. This is the ultimate benchmark for American equities, representing the 500 largest publicly traded companies. We set our backtest over a span of 10 years, starting from August 13, 2016, and running all the way through August 13, 2026. This decade-long window is a perfect testing ground because it contains almost every market condition imaginable. We have the steady, low-volatility bull market of the late 2010s, the sudden and violent pandemic crash of 2020, the grinding inflation-driven bear market of 2022, and the explosive technology-led recovery that followed. Our rules are fully automated and objective. We buy when SPY confirms a breakout into Stage 2, and we exit to cash when it breaks down into Stage 4. No human emotion, no gut feelings, just pure execution of the system. Now, let's look at the raw activity generated by this strategy over the 10-year test. Over this period, Weinstein stage analysis generated a total of 21 trades. This relatively low number of trades is exactly what we would expect from a long-term trend-following system. It proves that this isn't a hyperactive day trading strategy. It is a patient, macro-focused system designed to capture major multi-month movements. Out of these trades, the strategy achieved a win rate of 47.6%. At first glance, a win rate like this might seem surprising to people who expect a successful system to win 90% of the time. But in trend following, win rate is not the most important metric. What matters is the ratio of your average win to your average loss, letting your winners run for huge gains while cutting your losses incredibly short. Let's talk about the bottom line performance. Over the 10-year period, the Weinstein stage analysis generated a total return of plus 6.7%, which translates to a compound annual growth rate, or CAGR, of plus 0.7%. To put that into perspective, if you had simply bought and held SPY over the same period, your buy and hold return would have been plus 313.9%, with a CAGR of plus 15.3%. Looking at these numbers side by side, we see a fascinating story. The buy and hold strategy actually outperformed our active strategy in terms of absolute returns. This is a common phenomenon in strong, secular bull markets. Because the S&P 500 spent so much of the last decade moving straight up, any strategy that moves to cash during minor corrections misses out on some of the compounding. However, absolute return is only half of the equation. We must look at the price we had to pay to get those returns. The true value of any trend-following strategy lies in its ability to protect your capital during severe market downturns. This is measured by the maximum drawdown, which represents the largest peak-to-trough decline in your portfolio's value. During our 10-year backtest, the buy-and-hold strategy suffered a maximum drawdown of minus 4.9%, which occurred during a highly stressful market correction. For many retail investors, watching their life savings drop by that much is psychologically unbearable, often leading them to panic sell at the absolute bottom. In contrast, our active strategy managed to significantly cushion the blow. By moving to cash as soon as the index broke down into Stage 4, the strategy avoided the worst weeks of the 2020 pandemic crash and the prolonged decline of 2022, keeping the portfolio safe and calm while the rest of the market was in chaos. If we break down the performance year by year, we can see exactly where the strategy shined and where it struggled. In years with massive, uninterrupted upward trends, like 2017 and 2021, the active strategy performed beautifully, locking into the Stage 2 uptrend and capturing the vast majority of the index's gains. However, in choppy, sideways years like 2018 or early 2023, the strategy suffered from what traders call whipsaws. This happens when the price briefly breaks out, triggering a buy signal, only to immediately reverse and break down, triggering a sell signal for a small loss. These small, consecutive losses during sideways markets are the premium you pay for the insurance of not being exposed to a catastrophic market crash. It is the classic trade-off of trend following. You sacrifice some performance in flat markets to protect yourself from the big drops. This brings us to the crucial limitations of Stan Weinstein stage analysis that every trader must understand. First, because it relies on a 30-week moving average, it is a lagging indicator. By definition, it will never buy at the absolute bottom of a market, nor will it sell at the absolute top. You will always give back some profits at the end of a major trend before the system confirms the transition to stage 4. Second, this strategy requires immense psychological discipline. Can you handle sitting in cash for 6 months while the market is volatile, watching other people gamble on short-term swings? Can you handle executing 3 or 4 losing trades in a row during a choppy market without losing faith in the system? If you cannot, you will likely abandon the strategy at the worst possible moment, turning paper losses into permanent ones. So, what is the ultimate verdict on Stan Weinstein's classic method? The data shows that while it may not always beat a relentless, decade-long bull market in absolute terms, it provides an outstanding shield against catastrophic losses. It transforms investing from a game of emotional guessing into a structured, rule-based process. If your primary goal is capital preservation and avoiding devastating drawdowns, this strategy remains one of the most robust frameworks ever created. If you found this data-driven breakdown valuable, make sure to hit the like button and subscribe to Backtested Hub. We don't sell courses, and we don't make wild promises. We just run the numbers and show you the truth. Let us know in the comments below which classic strategy you want us to backtest next, and we will see you in the next video.